All right, good afternoon, everyone. We wanted to give them a minute or two from the start time in order to get everybody in. Like Ken said, we had about 350 people sign up. So we just wanted to give enough time to let everybody get in and make sure that they are able to hear us. So welcome to our second webinar on the CARES Act and particularly these PPP loans. We did one, I would say, 2 weeks ago, right when the information first came out, that was largely focused on providing information to everybody about the program and really focusing on the application. Today, now that we've had some time to get a lot of applications in, I know many are still pending, but we are starting to see clients receive funding. We have heard stories of other people telling us they've received funding. We wanted to focus a little more on the permitted uses, take a little look towards how the forgiveness may actually work, and give some best practices right now as we see it for tracking and the internal controls be with the funds. So this, along with all the other material, can be found at our website. The information that we are providing today is current as of April 15th, 2020. I didn't see any major changes come out this morning. Yesterday afternoon, the self-employment guidelines came out. A few interesting points in there that we'll work in throughout our presentation. This information is based on our interpretation of the CARES Act and any guidance that has been provided. There are still some questions with a lot of items, and there hasn't been guidance on everything yet. So some things that we're saying are, again, our interpretation. This may change as more guidance comes out. Just want to reiterate, this webinar is informational and for educational purposes only. You should not rely on this solely or use it to contest any IRS, SBA, or other penalties and assessments. We cannot make any guarantees to your eligibility for these programs or any related benefits. Time permitting, we will answer all questions that we can at the end of the webinar. And I want to once again thank everybody for their attendance. We're seeing great turnout at these webinars. I think there's a lot of curiosity and questions with these programs, and we're happy to be able to try to help as many people as possible. So that all being said, again, our webinar today is on tips and best practices on the use of the PPP fund. So just a quick 30 seconds of shameless promotion for the firm. Today we're going to have Ken Cerini. Ken is the managing partner of Cerini and Associates. His expertise includes industries in the nonprofit area, educational organizations, and healthcare providers. I am Edward McWilliams. I'm a tax director at Cerini and Associates. My expertise specializes in healthcare, financial services, technology, and professional services. So those are our two speakers today. Cerini is a firm located on Long Island. We have about 50 professionals, 5 partners, and we specialize as a firm heavily in the nonprofit, education, and then small business tax and advisory sector. So what we're going to be covering today, we have 3 basic things we want to go over. Number 1, we want to provide just some updates on the PPP program itself, real high-level stuff. Next, we're going to talk about the permitted uses and a look towards forgiveness. Again, forgiveness regulations and guidance haven't really come out yet, so there's a lot of questions on how a lot of particular features are going to work. The law itself allows for some quote unquote de minimis regulations to be given out by the Secretary of the Treasury or the SBA Secretary. So there is still a lot of information we don't have answers to. And I hate not having answers for questions, but right now they just aren't there. And then finally, Ken's going to take over and kind of go over some best practices for tracking and the internal control environment around the use of the PPP funds. All right, so starting with our program updates. So as I kind of said in our intro, many of our clients and contacts have received funding. That's great. However, there are still many clients and contacts that have yet to receive funding and have been trying to work through it with their bank. I hate this answer, but it's really the only one that we can give right now, is it's a patience and waiting game. There's nothing that we as accountants or advisors can really do to help you with this. It's really going to depend largely on staying on top of your bank, staying on top of any of the information they provide, and being prepared to answer any questions that they may have, as fast as possible. Nearly every major bank have a system online right now, but some are working more efficient than others. We've had great experiences with Chase, with TD Bank, a couple local Long Island banks, but we're also still seeing that many banks are only doing this for their participating customers, meaning that if you don't have a relationship with Chase per se, you won't be able to apply for them for this program. You still need to largely focus on whatever is your current banking relationship. Additional lenders have been approved. This happened on Friday afternoon, I want to say, that Square, who is a credit card processing company targeted at small businesses, PayPal, and Intuit, aka QuickBooks, have all been approved to be SBA lenders. And what the hope is that people who are unable to be served by their primary banking relationship, whether it be a situation that the bank is not participating or it doesn't have an SBA lending arm, which there are some more on the credit union level, that these lenders will be able to provide these loans. And for people that are having difficulty working with their primary bank, perhaps their systems aren't online, then you may be able to apply for them as well. A key point to take note of: on your application, you specifically state you do not have an application pending elsewhere for a PPP loan. So you shouldn't go out and apply everywhere necessarily. You should only be working through the process on a limited basis, and make sure you only give one signed official application in. You can express interest to other lenders and see if anybody does give you a little more, I'll use the word attention, than your current bank, but don't apply multiple times. There's a difference between the application, which is the signed or electronically signed forms, versus the actual, expression of interest that some of the banks are having. So keep that in mind. As of yesterday afternoon, there was an estimate that about 60% of available funding has been committed to approved, which means they have an E-Tran assigned number loan in the SBA system. I've heard reports that today that number's up to 65 or 70%. So there was announced to be limited funding on this program, and it sounds like a lot of it has already been committed to approved loans. Now, that's a very scary proposition for a lot of businesses and organizations because they haven't maybe got theirs yet, or they haven't had a chance to apply. All we can do is tell you to stay the course, see what happens as the process goes on, and then when it becomes clear that maybe this program won't be available for you as an organization, we can then take a look at some of the other alternative programs that are in place, such as tax credits that exist. But right now, we're still heavily pushing into the PPP program. There have been
one little thing I want to throw
Yes.
in there. I've heard that there have been 1.1 million loans already approved. So there's a large number of loans out there, and we're still holding out hope potentially that there will be some additional funding that comes through here for these types of loans. But again, there's no guarantee. I know that it's gotten stalled in the Senate. So.
Yeah. So there were talks of legislative support late last week. There was hopes of doing just simple voice majority votes on increased funding on this. It has stalled because of some political items here and there. There is support in a broad sense to do it, but support and actual funding and approval are two different items. And one last thing we just want to touch on, that I think it was last Thursday, some more FAQs came out, and one item that came up was this alternative size standard that potentially allows primarily businesses, as our interpretation is, so something that is a for-profit entity that have more than 500 employees to still qualify for this loan, if they meet the alternative size standard, which is having a net income of less than 5 million over the last 2 years on average, and a tangible net worth or equity of less than 15 million. So we are seeing updates. It is a continually evolving process. Everybody's trying to apply. Many of the banks are overwhelmed. They're doing everything they can to try to help people get these loans. I know it may not feel like that. I know it feels like you're being ignored and there's frustration everywhere. I would like to hope it's not intentional, but I would like to share that everybody is largely going through the same process. And right now, all we can really do is just stay the course. Okay, so that's just a quick high-level update on the PPP program itself. Now I want to go over 5 different scenarios of permitted uses and a look towards how the forgiveness we think is going to work. Again, we haven't seen clear SBA guidance. There are a lot of uncertainties and nuances and questions that we have as much as you have as organizations and business owners that we wish we had answers to give. We can make some educated guesses and provide what we think based on the law, but having no clear guidance or something to go back and look upon, no precedent to look at, it's a little more difficult. But we know that the SBA and Treasury are working hard. They have been focused largely, number one, on getting the loans to everybody. That had to be the number one focus. Now that that part is in process and moving along, even if it may feel like it isn't for a lot of borrowers, they can now start to think about, well, how is the forgiveness really going to work? So again, this is our interpretation of how it looks. Things may change, and there may be circumstances that exist that can change some of this. Okay, so let's first go over the permitted uses of PPP loans. These are covered in the applications itself. It's been covered in the prior guidance. These are the only items that you can use these loans for. So you have your permitted uses and you have your forgivable uses. So I'm going to first go over your permitted uses. You can use what I call category A, your payroll costs. Your payroll costs are cash compensation up to $100,000 per year annualized, any group health benefits, retirement contributions, any state and local taxes. We did get confirmation yesterday in the self-employed guidance that state unemployment is considered a state and local tax. Any applications that we have worked with any clients on and or spoken with them about, we have said that you should include this number based on our interpretation. So we have category A, your payroll costs. We have category B, which are your rents, your interests on mortgages, and your utilities, gas, electric, water, telephone, and internet. That's our category B items. Category C is interest on your prior debt. And if you'll notice, your forgivable uses and permitted uses are nearly the same. However, you cannot get any forgiveness for category C, which is the interest on prior debt. So any lines of credit that you may have outstanding that you're using PPP loans to help pay the interest parts right now, you can't use principal, but any interest, that is a permitted use, but not a forgivable use. And the reason we have category A and category B has to do with how you can use them and how you can be forgiven. At least 75% of your PPP loan has to be spent on category A items, AKA your payroll costs. Up to 25% of your PPP loan can be used on your category B and C items, and up to 25% can be forgiven on your category B items. Anything that falls outside of these particular uses is not a permitted use of a PPP loan. Using it for this manner will undoubtedly jeopardize any potential forgiveness you may have. and it may result in a deemed default on your loan and or other consequences. I think that Ken will be covering a little more in depth as he talks about the internal controls and best practices when it comes to these. So keep that in mind. These are what you can use them for. It's a limited use. The idea, the legislative intent of this program was to keep people employed, keep everybody on payroll. So that's why they want you to use this on payroll. Finally, the clock starts per the law 8 weeks from disbursement. So once you get the funds, you have an 8-week period to use them on these costs for forgiveness. And that starts from when you get the money. So keep that in mind that if you got funded yesterday, you're already on the clock. Hence why we wanted to get this webinar out as fast as we could now that we were starting to see some movement in this and really help clients and our contacts understand, okay, well, now I got it. Now what do I do with this money? How do I track it? So on and so forth. So that covers the permitted uses of these loans. We're going to run through basically 5 scenarios here, and this is our general background of our organization. The organization has 100 employees and an average annual wage expense in total of $9 million. The organization offers health benefits of $1 million per year and a retirement contribution of $500,000 per year. There are 10 employees who make more than $100,000 per year, totaling $700,000. Okay, so their PPP loan is calculated as follows. We take in the entirety of their wages, reduce by the amount of anybody who makes in excess of $100,000 per year. So there are 10 employees who made more than $100,000 at $700 total. There's $1 million in health benefits and $500,000 in retirement contributions, coming for an annual payroll cost of $9,800,000. Our total payroll costs, disregarding the amount over 100,000, is $10,500,000. But for PPP purposes, our allowable payroll costs are $9,800,000 as calculated there. I divide this number by 12, multiply it by 2.5, and that gets me to my maximum PPP loan amount of $2,041,667. That is our loan throughout all of the examples that we're going to be presenting next. Your loan amount is based largely on your historical information. Now, we've had some clients that we've worked with where they have seen significant changes even versus last year that maybe happened in the third quarter of the prior year and have advised them to apply for a lower loan amount. That is allowable. However, we're noticing that many banks are really just trying to give everybody the maximum amount, but nothing says you have to apply for the maximum amount, just that you can apply for up to this amount. Since most people are looking for the maximum, that's how most people are applying. But keep in mind, nothing says you have to do that. So you should work with your banker as you're working through this process that if you feel there is a business reason why you should not apply for the maximum amount, then perhaps you should not, and you can calculate that accordingly. But this is a general background. We'll use the same fact pattern as our baseline for all 5 scenarios we're going to run through. And as a high level, again, 100 employees is our baseline number with this level, and our loan amount stays the same regardless of what happened in 2020 as a general example. Okay, so scenario 1 is our easiest scenario. Now, I will disclaim that what the example scenarios we're going through, they are somewhat academic to a degree. The real world has a lot of nuances and other things that don't necessarily fit as well into these broad-based examples that we're giving and going through here, but we're trying to just show on a high sense how everything is going to work. So keep that in mind as we go through this. There are a lot of questions that are coming up about service periods and when does the payroll count for, and so on and so forth. We're taking the interpretation based on what we have seen and our overall sense that is based on when you expend the money, not necessarily what period it covers, but you also may not be able to prepay extensively expenses that you haven't incurred per se. You really want to kind of use right now common sense, I think, is the best way. Again, we're all so used to government programmings having these clearly defined guidelines and rules and experience for us to lean on that we can see what it's supposed to be like. Right now, we're kind of still flying without a lot of instruments. So we're making our best efforts here to try to help as we can and provide the information as we see it. So on scenario one, company has no turnover, no layoffs, no compensation changes. Everything is more or less status quo. So we see they have wages of $9 million, health benefits of $1 million, and a retirement contribution of $500,000 for total payroll costs of $10,500,000 or $437,500 per period. They are going to pay payroll twice a month in every one of our examples because it just makes it a little bit easier for us. They have rent of $190,000 and interest on an outside line of credit, not mortgage interest, that is $10,000 per month. So what we can see here now is with our loan proceeds, we can take the amount of payroll that is below $100,000 per person and use our loan proceeds for that. So of our $437,500, we can use $408,333,000 per pay period on our from our loan proceeds. The amount above $100,000 per employee is not considered an eligible payroll cost for PPP purposes and should come from outside funds. So if we were to take $700,000 and divide it by 24 pay periods, that comes into $29,167 per period that we have to fund from outside sources. That gives me my total payroll cost of $437,500. I pay 2 months of rent and I pay my interest payment twice on my line of credit, which in total shows that I have used $2,333,000 of my loan amount for allowable uses. Okay, so my loan amount was $2,041,667. I used $2,033,333, meaning I received or I did not spend $8,333 more than I used my loan for. Now, my loan uses and my forgivable uses here are different because I have spent $20,000 on non-allowable, non-forgivable interest. It's permittable, but non-forgivable interest. So that makes my forgivable uses $2,013,333. I have no reductions in FTEs. I have no reductions in salaries. So that means my total amount forgiven is $2,013,333, leaving me with a loan balance of $28,333. So when we look at that, that is a relatively simple one to follow when we think about it conceptually. I spent $2,033,333. Of that, $20,000 was a non-forgivable use, and there was $8,333 more that I received than I used. Therefore, my loan amount is now $28,333. So that's kind of our simple baseline scenario. No turnover, no layoffs, no compensation changes. One of the questions we're getting a lot is, if I get funded more, what can I do with that? And can I pay it back? There is no prepayment penalty. So in this scenario here, if at the end of 8 weeks, you know that you're not going to be forgiven that $8,333, you should be able to make a payment to your lender that will allow you to repay the loan. So just keep that in mind when it comes to that. The remaining loan has a 24-month period with 6 months deferred at a 1% interest rate. The promissory notes that we have seen basically have it self-amortizing over 18 payments. But I'm sure each bank is allowed to and probably has a somewhat different note from bank to bank, but I wouldn't be surprised if every single bank had the same sort of terms of self-amortizing, and every note does have the same interest rate. Okay, so that's our first scenario. Our second scenario. In this case, we have seen a reduction in staff. So the organization had one employee leave voluntarily on January 15th, 2020, and a second was laid off on February 15th, 2020. The employees that were laid off did not make over $100,000 per year, had salaries of $92,222, health benefits of $10,000, and retirement benefits of $5,000. Those are annual basis because we're using the annual basis to calculate everything. So now, in this case, our wages have declined by the two salaries that we no longer have, as have our health benefits and our retirement contributions, leading us to total payroll costs of $10,285,556 or $428,565 per period. Once again, we now go through the loan proceeds. We can use $399,398 for our payroll costs. For those, that's the amount of every employee that makes less than $100,000, plus up to $100,000 for any other employee that makes over $100,000. We still have to use $29,167 of quote unquote outside money to get us to the $428,565 per period. We have 4 payrolls of that amount, 2 payments of rent of $190,000, 2 payments of interest on our credit line of $10,000, leading us to total loan uses of $1,997,593. Now we have our loan amount, still the same amount, $2,041,667. I used $1,997,593, meaning that I have got a quote unquote excess of $44,074. From that $1,997 that I used, $1,977 is forgivable. Okay, so that's what our base is to determine how much could potentially be forgivable. Now we're going to look at how the FTE reduction should work based on our understanding. Now, there's a big question here that has to do with the measurement of base period, what happens on a voluntary exit. I was using this more as an example to show how an FTE reduction would work. So just keep that in mind, that the way the FTE calc should work per the SBA guidance I have seen, how they normally count employees is the average per payroll. So I take a look at my payrolls and see I had 100 FTEs as of my January 15th payroll, 99 as of my January 31st and February 15th, and 98 as my February 28th, 2020 payroll, meaning I had a total over the 4 payrolls of 396 FTEs, or an average of 99 per payroll. Now, we have not had any guidance as to how an FTE is potentially calculated. At this point in time, I would defer to the Affordable Care Act guidance, which uses a 30-hour FTE equivalent. The SBA may use more, they may use less. We don't know yet. That has not been given to us on any context. So my base FTEs on those 4 payrolls were 99 on the calculation on the right side of this slide. My FTEs during the covered period were 98. Remember, 100 employees, and I lost 2. So now I have a reduction of approximately 1% of my workforce. So that means my forgivable uses are reduced by 1%, or 19,976. So I take my forgivable uses less my total reductions, means that my loan forgiven is now 19 million. Wow, double mess up there. 1,957,617. That leaves me with a loan balance of $64,074. How I got there? I received in excess 44,074. I had a 20,000 non-allowable use, and I had 19,976 that was added to my loan balance at the end there. Okay, so now on to scenario number 3. Maybe an unlikely one under the circumstances, but at least one that I wanted to kind of show just how it works based on our understanding. So in this case, the organization had some raises take effect in early 2020, about 300,000 in total, all for staff below 100,000 in annual compensation. The organization also had 5 new hires at $95,000 per year, $10,000 per year health benefits, and $5,000 per year of retirement benefits. So now my payroll costs exceed how much my PPP loan was for. That's the point of kind of this scenario here. So under this, I still have the use of loan proceeds for any payroll costs for employees less than 100,000. I still have to use outside money for my payroll cost above 100,000 for any of those employees, which is still 29,167. Still have 2 months of rent, and I still have 2 months of interest for 2,175,000 of total PPP uses. Now, if you notice, this is a shortfall compared to what I got. I had 2,041,667 of a loan, but I had uses of 2,175,000. So I have a shortfall of 133,333, and I have a higher number of FTEs than I did over the total period. So in this case, I have no reduction in forgiveness, and the full amount of my loan is forgiven. However, I was not given enough to cover all of the compensation that I paid. And the reason I wanted to show this example was it wouldn't be uncommon for an organization to have based their numbers on 2019 payroll, and starting in 2020 to have many staff that have received a raise, whether it's a merit raise or a promotion or just cost of living. And I wanted to show that in that event, you can still use your current payroll amounts for your loan proceeds, so long as they don't exceed 100,000 of cash compensation per employee, and then you will be fine. You don't have to do any reductions or calculations or anything like that. And you don't have to rely on your 2019 salary number as what you can pay in payroll costs. Your 2019 salary number is what you used to calculate your loan, but you still pay it based off of 2020 numbers. They're independent, but related events. The loan calculation is one thing, the loan use is another. And again, this scenario is when you have new hires, not when you lay off. I may have said lay off earlier, I apologize. So that's scenario number 3. So now scenario number 4 is a straight 30% reduction in compensation across the board. Everybody. No other changes in staffing or benefits, but everybody took a 30% pay cut across the board. So now my wages are only 6.3 million when they were significantly higher under my baseline case. I still have the same retirement benefits and the same health benefits, making my total payroll cost 7.8 million or 325,000 per period. Under this scenario, we have loan proceeds of 304,000 that you can use for the payroll. That is the cash compensation of everybody below 100,000. And I have now still people above 100,000 that I have to use outside money for, but it's 30% less than it was on our prior slides. On prior slides, it was 29,167. Now it's 20,417, bringing me to total payroll of 325,000 per period. I still have the same amount of rent and the same amount of interest. So in this case, I had gotten my loan again on my 2019 numbers for $2,041,667. I used $1,618,333, and I had forgivable uses of $1,598,333. So we didn't use anywhere near as much of the loan that we got. You actually have a surplus of $423,000. But in this case, we now have the salary reduction feature coming into place. And the salary reduction feature of greater than 25% results in a add back or a reduction of your forgiveness by $15,208 per period at 4 periods, gives it to you at $60,833, meaning your total loan balance now is $504,167. The $423,333 that I got extra, plus the $20,000 I used on non-forgivable uses, plus the reduction of greater than 25% per employee that I have to add the excess in. So what we have here on the next slide is a sample of how that calculation came about, right? So it's a per employee calculation. This is a separate calculation than the FTEs, but rather a per employee calculation based on their pay in the most full prior, what's the exact term? Previous full calendar quarter is the term that is used in the law. Whether that means fourth quarter of 2020, fourth quarter of 2019 or first quarter of 2020, I cannot necessarily tell you yet, because you're going to see many people who have a first quarter of 2020 that isn't necessarily full employment, because March 2020, many organizations did have a reduction in staff. But what we look at here is what was the per pay period payment on the prior quarter. What is my per pay period payment now on the current quarter? So it's a 30% reduction on that. So it went from, on employee one, from $3,333 to $2,333, a 30% reduction. When you do the add back, all you have to include is the amount that your reduction exceeds 25%. So in this case, we had a 30% reduction, but we only really need to worry about the excess, which is 5%. How much above 25% did the reduction happen? So in employee one's case, that's $167 per pay period that I have to reduce my forgiveness by. On employee two, same calculation. They were paid $35.42 in the prior quarter. They are now paid $2,479 in this quarter per pay period. That is a 30% reduction. The floor is 25%, meaning I have to recapture the excess 5% or $177 for that employee per pay period. And I go through this calculation for employee 2, 3, 4, all the way through employee 90. for the employees that are making more than 100,000 per year, they do not count in this calculation. So notice how I have 100 employees in my scenario, but I only need to do the calculation for the employees that make less than 100,000 in compensation. So that is how we got to the 15,208 in our prior example. That was reduced over 4 pay periods, leading to a total reduction from my forgiveness amount of $60,833. So had I not had that salary reduction, I would have had a forgivable use of $1,598,333, and now I have to reduce it by $68,833, making my forgiven $1,537,500. I add that to my overfunding of the loan, plus my non-forgivable uses to get to what my total loan balance will be. So that is what scenario 4 looks like. And it's kind of now building up to scenario 5, where we have both a compensation reduction and an FTE reduction. So in this case, our organization reduced their FTEs by 5 starting on March 1, 2020. Each of these layoffs were at $95,000 per year in cash compensation, $10,000 per year in health benefits, and $5,000 per year in retirement. The organization also reduced their wages by across the board by a 30% amount. So in this scenario, our total payroll cost is now $7,392,500. Our wages are down from the reductions of FTEs and are down from our 30% cut. Our benefits and retirement are down from the reductions of the 5 FTEs. I have a per period cost of $308,021. Like in our prior example, we have how much we can use of the loan proceeds, which is up to $100,000 of cash compensation per employee, plus any other applicable costs. We have our outside money, which is the amount we need to use to pay employees greater than $100,000, leading to my total payroll costs of $308,021 per payroll. Now, another wrinkle that comes up here is, in this scenario, our rent and interest costs, if we use the full amount, actually would exceed 25% of the payroll costs, or of the total loan, I should say, of the total used loan. So we have to actually reduce how much of our loan proceeds we're using on the rent by $7,851, and the same on the interest, because in this scenario, we would not have then used at least 75% of our loan on payroll costs. We would have to reduce how much of the rent we are deeming used from the loan proceeds. So keep that in mind too. It's kind of a last second curveball that came up, but I wanted to kind of show a quick sample of, hey, if you have such significant reductions, how it may impact your other spending as well. In our scenario now, we still have the same PPP loan amount of $2,041,667. We have used $1,533,889, meaning that I was overfunded by $500,778. I have forgivable uses of $1,514,715. So that is taken by adding up the loan proceeds that I was able to use on payroll and rent over the 8-week period. So now we're going to calculate our reductions. The first reduction we have to calculate is our FTE reduction. In this case, pretty simple calculation. We had 100 FTEs during our base period, which was January and February 2020. We reduced it starting March 1st, and now we've continued that reduction throughout. So that means during the covered period, we had 95 FTEs, meaning we retained 95% of our workforce. You will have your forgiveness reduced by the 5% of the FTE reduction that you have. So you're going to have, of the 1,514,000, 5% of that gets reduced, or 75,736. You also have a case here where there's a salary reduction of the remaining 85 employees who don't make more than 100,000. That totals 14,219 per period, and you have 4 periods, leading to 56,875 of reductions there, or a total reduction of $132,611. So that now means, from our forgivable uses of 1,514,715, we have taken a loan reduction of 132,611, leading to a total forgiven of 1,382,104, or a loan balance still of 659,562. Now that does sound high, but remember, you still have 507,000 from the loan you initially got that you were not able to use. So really, your loan balance here is still only how much you've had in reductions and how much you used in non-forgivable but permissible uses. So just to kind of go again, the compensation reduction calculation. We now look at the 85 employees that we still pay. We look at how much they were paid per pay period on the prior quarter and how much they were paid on the pay period now. We see here employee 1 still has the same reduction. They have a 30% reduction from 3,333 to 2,333. That's a 30% reduction. We have to recapture the 5% that's above 25%, or 167. That's how much of that individual employee's recapture is. The second employee, same calculation as prior, and so on and so forth on all 85 employees. Again, this compensation reduction per the guidance is on a per employee basis. There may be regulations that come out that allow for alternative methods, but as we see it right now, as we understand it right now, it was very clearly stated this is a per employee basis. So if you reduce 4 people but increase 6 different people, that's not going to help you. You still have to take into account the 4 that you reduced. So that's what I was trying to stress when it comes to that being a per employee calculation. And just to show you again how the FTE calc will work based on our understanding, I had 95 FTEs across all 4 of the payrolls in my 8-week period for 380 FTEs in total. And that gives me 95 per covered period. Again, the average of 95 4 times is going to be 95, but that's how the calculation will theoretically work. All right, lastly, before I turn this over to Mr. Ken, I've been stressing this throughout the presentation. I stressed it early. We still have a lot of uncertainty when it comes to this forgiveness. There is a lack of guidance and regulations that gives us, a high level of we're trying to interpret it based on the law that is written. When the SBA and Treasury come out with regulations, we will do another webinar that helps to explain the forgiveness. As more information becomes available, we are making it our effort to try to push it out to you as fast as possible and as digestible as possible. I know that this is a lot of numbers and stuff, and I'm an accountant, so to me, numbers are my natural territory, but it is we're trying to push it and trying to make it as accessible and digestible for everybody that we can. But just some areas in forgiveness that keep popping up. What about voluntary turnover or exits, or employees that don't want to return? We don't know how those are necessarily going to be treated. We don't know how FTEs will be defined. That is not something that has been clearly put out in regulations yet. Again, my thought is that we will have it on the Affordable Care Act calculation. But that is just because it exists in law and it seems like a pretty easy baseline that most people already have to do anyway. it could come out differently. Um, Something that has kind of crossed my mind, that given how we've seen this program change on the fly so much, there runs the potential that a regulation could come out that any unspent amount that you got may require immediate repayment. I doubt that's going to be the case. I very highly doubt, because there is a promissory note that you have to take out on this, and you are on the hook for it, and nothing in the note makes me take that to think is going to happen. But just seeing how much can change, I kind of just want to, I wouldn't necessarily be 100% planning on using my unspent funds in the period afterwards, because maybe something could come out that makes that difficult to happen. Um, I think the intention always was that your um, unforgiven amount should only be equal to the unspent amount. So maybe that might be the case when the regulations come out and we understand it a little better, that really what they were going for, that the legislative intent was, you spend this on payroll, you get the forgiveness. That's what I think they wanted to do. But you know, that's again a little bit of conjecture here. I don't know 100%, but I think there's some possibility there. There is this rehiring safe harbor that I didn't really touch upon on my examples, because if I started to work that in, we'd be here until 7 o'clock tonight. And as much as I enjoy talking, I don't enjoy talking that much. But there is a allowable safe harbor, I'm calling it, that if you had a reduction in staffing or in payroll, that so long as you fix it between basically by June 30th, you won't have it counted against you on your reduction calculation. So there's a kind of a question as to how that's going to work. Is it that the reduction can only happen, or the fixing can only happen in my covered window, the 8 weeks of the loan, or can it be afterwards? Can I still get credit for it? We just don't 100% know on that one. And there's a question of how long do the FTEs have to stay if you're trying to rehire them? Do I have to keep everybody on through June 30th and at the same level, even though I only got 8 weeks of payroll loan? Like that, it seems like you pay two, the government pays two, we pay one scenario. You know, there's some uncertainty there. The law says that your forgiveness is based on the covered period, which is 8 weeks after you get the loan. So I think that's the time where the staffing and salaries are going to matter the most, but we just don't 100% know. We don't know how long the FTEs would need to stay when you bring them back. You know, is it the kind of thing that I brought someone back on June 30th and I can let them go on July 1st? That sounds against the legislative intent of what's going on here. We don't know what impact things in the post 8 week period are going to have. These are some of the questions that we're seeing and that we have. And I wish we had answers for you. We just don't have many to give right now. So that being said, I wanted to leave Ken enough time because he has a lot of great suggestions and guidance when it comes to the use of these funds and internal controls and all of that. So I am going to give Ken the wheel here. Let's make sure I did that right. All right, Ken, you should be able to get going and you can unmute yourself.
All right, I am unmuted, and there are a lot of questions. I was trying to answer as many of as I could, as quickly as I could, but they're coming in faster than I can respond to them. So Ed, I don't know if you want to start trying to respond to some of them too. For some reason, Ed, I apologize, but I don't seem to have control over the screen.
Okay, hold on.
So if you can control the screen, that's fine.
Yeah, all right, I'll just do that. That sounds like a plan.
Okay, so Ed got to talk about the confusing but fun part, where he got to talk about the fact that you guys got money and what was going on with that that money component of it. My part of it is a little different. I'm going to try to bring everybody back to earth a little bit and talk a little bit about the internal control environment and why that's very, very important, and also talk a little bit about the teeth behind the CARES Act. Ed, do you have? Can you get control over this or what? There you go. So one thing that everybody needs to keep in mind is when the CARES Act was created, as part of the CARES Act, the government created a three-part oversight structure. They understand that there's going to be a high level of fraud associated with these loans, and they want to make sure that there was a avenue for them to go in and monitor and go back, audit, and penalize individuals who are not doing things appropriately. So it's important for everybody to understand that, again, there was a three-part oversight structure put in place. There was the Pandemic Response Accountability Committee. And the purpose of the committee is they're authorized to conduct investigations, and they have to produce reports on a biannual basis to both President and Congress. There was $80 million earmarked for this committee, and the committee is set to run until September 30th of 2025. In addition, there was a Congressional Oversight Committee, which is responsible for supervising the implementation of the CARES Act. And finally, like any other large component of funding that comes out of the government, there was a special inspector general for pandemic recovery that was created and given $25 million and provided with the authority to conduct audits. Now, we're not necessarily sure how any of these audits are going to be determined, who's going to get selected. There definitely is a whistleblower component of this. So if someone were to blow a whistle and say that an organization incorrectly or inappropriately received the funds, there's a likelihood that you might get investigated. They may do some sort of analytics to make selections, looking at organizations analytically to see if there's something that spikes out in their financial results as compared to the funds that were accepted. So again, it's not really sure how any of these audits are going to take place. As I said, there's currently a 5-year window of time for these audits, but it's also not sure whether that could be extended. So there is a possibility that if they find that there's a lot of abuse and they continue to find abuse within this system, that 5-year period of time could be extended. So again, it's very important that when we're looking at this and understand that there is going to be an oversight component of this, that organizations consider the need to establish internal controls. So Ed, next slide. So from an internal controls perspective, just a couple things that we want to talk about in terms of some of the best practices. Now, you don't have to do all of these things. These are things that we're recommending as potential best practices, because if a governmental auditor is going to come in down the road, you want to make sure that you do everything you need to do today so that you've got all the information set aside. So you're not scrambling 5 years from now or 4 years from now when an auditor knocks on your door. So some of the things that you might want to do, you might want to consider opening up a separate bank account to put the PPP loans in. This way it's clear as to the money coming in, and it's clear as to the money that's going out, so that you can then pinpoint what exactly each piece of the money going out was for. You don't want to be in a situation where the money necessarily goes into a general operating account, it gets commingled and accidentally gets spent on something that is not a permissible cost. Remember, when you applied for the loan, within that loan application, in that top quarter of the loan application, it asked you what you were going to use the funds for, and there were 4 permissible boxes there that you could check off. So you have to use these funds for those permissible uses. So you don't want to be in a situation where you accidentally utilize the funds for a purpose that is not permissible. And just to go over it very quickly, I'd like to go over what those permissible uses are. It's for salaries that are paid to employees. Salaries over $100,000 are not included or not permissible under this. It's the employer portion of health insurance, because the employee portion of health insurance is already included in the salary. It is any pension benefits that are provided by the employer. So it's the employer portion of pension benefits. It's any employer state or local taxes. The only state or local taxes we would have here in the New York metropolitan area would be your New York State unemployment insurance and your MTA tax if you're a large enough organization that would or company that would require to have to be paying the MTA tax. So those are your payroll related costs, including those health benefits would be dental and vision also. The non-payroll related appropriate uses for the funds would be utilities that you pay. It would also cover any rents. Now, in the most recent list of frequently asked questions that came out, it gave the indication that rents may not just be real property leases. It may also include personal property leases like equipment. But I think some of that is going to be clarified within some of the forgiveness information. In addition, if there is a mortgage, so if you're not renting but you own a building and there's a mortgage component, the mortgage would be a permissible cost. So again, just want to make sure everybody is aware that these are the permissible costs, and that's really what you should only be using the PPP loan funds for. The other thing that we're suggesting is that you create an electronic or paper file storage system where the backup support that's going to be used to substantiate the both the forgiveness and the loan amount is maintained. So you have all that information in one place. So again, if an auditor were to come in, you could go to that file, pull all that information in. It's been established now while you're going through this process and hopefully reviewed and vetted. Also, we believe that you should set up a separate cost center within your general ledger. Most accounting systems allow you to do utilize cost centers. So like if you're using QuickBooks, which is a very simple program to use, QuickBooks uses a concept called classes. So you would use classes within QuickBooks. And if you set up a separate cost center and then you charge your expenses to that cost center, once again, it becomes very, very easy for you to track. So then the expenses being charged to the cost center should be supported by the information that's in the electronic file cabinet, which then should equal the amount that's been pulled out of your bank account. So again, just trying to create that redundancy in that tracking system to make sure that the controls are in place. You also, when the forgiveness regulations finally do come out, make sure you carefully review those forgiveness regulations to ensure that you're only seeking forgiveness for allowable costs. I went over earlier what I thought allowable costs are going to be. It is possible that the allowable costs may be different from what we're expecting. So when those forgiveness regulations come out, we will be pushing that information out to the field, and we will be probably doing another webinar like this to share with you information regarding those forgiveness regulations. As Ed went through several examples, as you saw from those examples, there were a couple pieces of information that were very, very important. One of them was the salary levels that were being paid to staff and whether staff were being maintained at full salary or if there was a discount in the salary that was being paid to staff members. And if that discount was more than 25%, that had an impact or is expected to have an impact on the forgiveness calculation. So you want to make sure that you're able to show that during that base period, here's what the salaries of my staff were. And during that 8-week forgiveness period, here's what the salaries of my staff were, to show that there was no decline in the salaries that are being paid to your staff members that would result in a reduction in the forgiveness amount. The other piece that Ed referred to is he was talking about these staff FTEs. And again, while we don't really have a true definition of what these what an FTE is under the forgiveness provision, once we have that information, it's going to be very, very important, again, for you to track how many employees you had during your base period, and then how many employees you had during that 8-week period of time that you were obtaining the funding, or I'm sorry, the forgiveness period, that 8-week forgiveness period, because that 8-week forgiveness period, the staff FTEs in that period are going to dictate what the decline may be in that forgiveness amount based upon the calculations that Ed shared with us already. If you have within your organization a compliance person, so a lot of nonprofit organizations have compliance officers or Medicaid compliance officers, and some for-profits have internal control people. One of the things that you may want to consider is adding this onto the responsibilities of that compliance individual, so that when all this documentation is put together, there's someone with a fresh set of eyes looking at it. And if you don't have a compliance officer, excuse me, it could be someone else within your organization who's outside of the people who are putting the information together. So again, you have a fresh set of eyes. Or you can also outsource it and go to your accountant or your attorney or someone else who's knowledgeable about this to review, because it's going to be very, very important to ensure that this information is accurate as best as possible. You don't want to be in a situation where you provide false or misleading information on any of these documents, because there are fines and penalties associated with making false claims. So Ed? So let's look at what those penalties are. So if you make a false statement or overvaluing information, the fine is a $5,000 fine and/or 2 years in federal prison. If you're found to be embezzling funds, then the fine could be $10,000 and 5 years in prison. And in either case, you're going to have to make the government whole. So you're going to have to pay restitution for the monies that you received that you weren't entitled to. So again, I think it's in everybody's best interest, and I'm not trying to scare everybody. I just want to make sure that everybody understands that there's a responsibility here to do things right. And I think it's very, very important to make sure that you provide your best effort in putting this information together and putting this information together accurately, and you try to make the right decisions in terms of the information you're putting on any forms for either the loan itself or for the forgiveness of the loan. Ed? So what constitutes a false claim? So pursuant to the CARES Act, some of the things that could constitute a false claim is falsely claiming the company had less than 500 employees when it actually had more than 500 employees, or not properly looking at the aggregation rules that exist within the Act. So remember that, you know, if you have a company that does have over 500, there was the frequently asked questions that came out early last week, which Ed referred to earlier in the presentation, that if you have a company with net worth of $15 million or less, and an average net income over the last 2 years of $5 million, they could still qualify for this. But again, you have to consider also that if there are multiple companies that come together under the aggregation rules, you have to look at all of those companies in total and not just look at one piece of it. So again, if you falsely apply for a PPP loan and you're not qualified to because of the threshold of employees, that could be a false claim. Everybody had to make a certification when they took out the loan that they were impacted by the coronavirus in terms of qualifying for the loan. Now, exactly what impact means is tough, considering also that when we look at operations, the impact is probably going to be felt more now in April, May, and June than you actually felt it in March when you were making that assessment as to impact. And impact doesn't necessarily mean you lost a lot of money. Impact could also be impact on cash flow. Impact could be loss of revenue. It could be, you know, many, many different things. So again, I think, you know, you should be documenting within your files why you felt you qualified for the loan. And again, with anything having to do with governments and audits, documentation is the key component to everything. Another potential false claim is inflating the average monthly payroll cost to increase the loan amount. So remember, you're taking your total payroll, you're dividing it by 12, multiplied by 2.5 to figure out how much the loan amount is. If you over-exaggerate your staff and your staff payroll, and that's determined to be a problem, that could result in a false claim. Falsely claiming the loan money is going towards qualified expenses. Remember, you have to utilize these funds only for qualified expenses. You can't use it to pay for non-qualified items. And also, in terms of the qualified expenses being forgiven, inappropriately charging things and getting that stuff forgiven when it shouldn't be. Incorrectly disclosing employee counts, as we talked about before, employee counts are extremely important in terms of the FTEs for determining if there's any decline in the level of forgiveness that's provided. And then also incorrectly reporting qualified expense amounts to increase loan forgiveness. So if you create fictitious expenses in order to create additional forgiveness, that could also be a problem. So again, it's going to be very, very important for you to put in place proper controls. It's going to be very, very important for you to make sure that there's proper documentation and everything to substantiate what you're doing, because the downside of not properly documenting everything is pretty steep. I didn't want to take up a whole lot of time when I did this because I wanted to leave time for questions. I know right now we have, apparently Ed's been doing a great job of answering questions while I was talking.
They keep
we
coming
still have
in,
a bunch
Ken.
of questions out there.
You weren't kidding. For every one I answer, I felt like 2 more popped up.
Yeah, well, when I left it, there was about 85 questions. I think it's down to 37. So you did phenomenal, Ed. So, but I think we still have some questions. So Ed, if you want to kind of start grabbing some of these and start answering.
Yeah, let me just, all right,
So I'll just hit the one that's on the bottom here, are invoices for conference calls, Zoom, and WebEx forgivable utilities. My understanding, Ed, unless you know something different, is that they are not. They are not considered utilities.
I think that's a really great question. I wouldn't be surprised if it comes out that they may be, but as of right now, I would say no.
Next question, being a nonprofit and receiving government contracts or foundation grants, are we allowed to even apply? So the answer is yes, nonprofits are allowed to apply. Nonprofits do have to make the assessment, just like every other company has to make the assessment as to whether they were impacted. Just because you're getting, or just because you have a government contract doesn't mean you weren't impacted. You have to look at how the government is paying you. If you're being paid on a deficit funded or cost-based situation and they're funding all your costs, then maybe you aren't impacted. If you're getting paid instead on a fee-for-service basis, there is a possibility you are impacted. You also have to look at the operations that you're running now. I know a lot of organizations that are on the front line are paying combat pay and extra monies to their staff, which aren't included in the contracts that they have. So if you're one of those organizations that is going to see an uptick in the amount of expenses that you have because of the virus and the pandemic we're under now, and those are expenses that wouldn't be covered under the current government funding system that's in place now, you are going to be impacted, and it might make sense for you to apply for funding under the grant.
One question that we have here is, will PPP money be taxable to the company? Will the expenses be made an expense to the company? So the PPP loan has been explicitly ruled as a non-taxable forgiveness of debt. Where there is a significant controversy right now on the tax side has to do with the deductibility of these expenses. Depending on how that turns out, we don't 100% know. There is a tax rule that says if you get tax-exempt income, you cannot deduct tax-exempt expense or deduct expenses against that tax-exempt income. So some people are starting to believe that that's going to limit the deductibility of this, but we don't 100% know. It's a multi-billion-dollar question. The Wall Street Journal did a great report on it over the weekend, I want to say. Richard Rubin is a fantastic reporter of the Wall Street Journal. He brought this up. When he brings things up, people notice. So that is a question that we don't 100% have an answer to yet.
There are a couple other questions regarding nonprofit organizations. Sorry, I just had, the questions are coming in so fast, they're clearing my screen. I just lost the question. Oh, there it is. If a 501c3 college school accepts these PPP funds, does that mean it is a receipt of federal funds triggering Title IX and other federal laws? Not really sure how these PPP funds are going, while they are federal funds, not sure how they're going to be treated in terms of some of the uniform guidance and some of the other impact on other federal funding. That's a question that we're going to have to see. There's a lot of items that haven't yet been considered in the nonprofit sector Even organizations that are, let's say, tuition-based funded through the state education department. I'm assuming that if you're getting funded your tuition, you won't be able to utilize any of these PPP funds to cover those salaries because you are getting funded for that. So that's the thing you got to keep in mind. If you are getting funded for the salaries in some other way, you should not be utilizing the PPP funds and not getting forgiveness for the PPP funds if you're getting funded in another way.
A question that I've seen pop up a couple times now is, can I use the funds for that expense if I did not check the box on the application? So I don't know how binding the application use area is. I would say so long as you comply with the law and that you use them in permissible ways according to the law, you should be fine, but they have not given any sort of guidance as to what would happen in the event that you check the box, say, for only payroll and you use some of it for utilities. I think it's still an allowable use. I think that was just informational generally. I would not overly sweat it, but if we hear anything, we'll certainly report on that.
One of the questions, do part-timers add to the FTE? FTE is full-time equivalent. It takes into consideration all staff, both full-time and part-time staff. So you would count the part-timers based in that FTE count.
The loan amount is based on 2019 year calendar data. And if we receive the loan on May 1st, what is considered the base period. So the base period only works for your FTE calculation. That's where you have a base period. Or I guess in the prior quarter as well. But number one, I would be shocked if you received the loan on May 1st because the program's almost out of money now and we're at April 15th. So by May 1st seems a little not possible, but your FTE base period is one of two periods: January, February 2020, or February 15th through June 30th, 2019 at the borrower's choice. You can use either of those periods for your FTE base period. You can calculate both and see which one gives you a more beneficial forgiveness, if you need to. So in terms of the law says most recent full count or count prior quarter is what they say. So we don't 100% know how that's going to be interpreted. My assumption is it's going to be fourth quarter 2019 because first quarter 2020 will have seen a significant payroll impact from the the March 2019 or 2020. So I don't 100% know, but that's where your measurement periods are going to be based on.
One of the questions that's out here, it says, would employer 401k profit sharing contributions for employees be allowable, forgivable? So employer contributions to a qualified pension plan are an allowable cost. So that would be like your matching contributions. Those would be allowable costs and forgivable costs under the PPP loans.
Ken, just make sure when you answer one of them, you mark it answer live. This way we can not have 40.
I have been.
Okay, cool. I am too. Just the number's not going down, so I'm trying to figure out why. If you receive an EIDL loan while waiting for the PPP, can you use the EIDL loan for payroll while waiting for the PPP to be approved? So the EIDLs, the economic injury disaster loans, not many people I have spoken to have gotten one. They did change the terms of the grant program to now be based on number of employees, not just a straight $10,000 grant. So keep that in mind. The answer to that is you can use the EIDL, you can't use them for the same costs is what the law says. So if you currently have an EIDL, and you're incurring payroll, you can use that. But once you get the EIDL or once you get the PPP, you should use that money for payroll. They haven't really thought so much about the intersections of these programs, but that's generally how it is. Before you have the PPP, if you have EIDL funds, you should be able to use them.
If health benefit costs $200, the employee pays $150 and the employer pays $50, which amount is included for health costs and forgiveness? It's only the employer portion of the health cost because the employee portion of the health cost is already included in the employee's wages. So it would be just the $50 in this example. And that's the amount that would be included in health cost and forgiveness.
Right, because yeah, it's good. If you're including the employee's gross wages as part of your forgivable cost, that gross wage already includes the part that they're contributing back. So yeah, I agree there. Um, can I request my health insurer for invoices for future months so I can pay during my 8-week period to count as payroll costs? They haven't necessarily provided guidance on this yet. We advise reasonableness here. We think it has to be costs that have a reasonable relation to the period and can reasonably be substantiated that they relate to your 8-week period. So we would not advise trying to prepay as many expenses as possible during the 8-week period because they probably will have one way or another not be considered a allowable or forgivable cost.
One of the questions that we've heard a lot, and I think it's kind of rides through some of the questions that are here, is organizations and companies are trying to decide what they should do in terms of furloughing employees and how that furloughing of employees is kind of impacting the loans and everything else. So just keep in mind that you're in a situation where the way these loans work, as Ed went over, uh, if you have a decrease in the number of FTEs that you have during that 8-week period of time following the date that the loan is funded, that decrease is going to have a negative impact on the forgiveness. So the way that's going to work is it's going to be compared to a base period. That base period is going to be either January and February of 2020, or Ed, doesn't also cover February 15th to June 30th?
Yes, for the FTE count, you have one of two choices: February 15th to June 30th, 2019, or January, February 2020. That's for the FTE base period.
So when you're looking at your FTE for the base period, you figure out those two, figure out which one is the one you're going to be utilizing, compare that now to the FTEs that you are going to have during that 8-week period of time. And that's going to impact how much of the loan forgiveness you get to keep, in essence, or get forgiven. So it's very important for you to kind of evaluate that in terms of your staffing patterns and what you're going to do from a staffing pattern perspective.
Is the application of PPP funds made public? The answer to that is yes, as far as I've heard reported, that anybody who receives these, either through a Freedom of Information Act request or otherwise, they will be made public as to who gets them. So there are some nonprofits concerned about getting this and then having issues with donors. I leave that more to your expertise, Ken. That's definitely your neck of the woods, but the information will be public.
Okay. One of the questions that's here is, if we got the PPP amount tomorrow and our payroll is paid 2 times per month, can we use the proceeds to pay payroll for the next 4 payrolls? That's going to be determined based on how that forgiveness wording comes out. Not exactly sure how that's going to lay out and whether it's going to be based upon when a payroll is paid, or whether it's going to be based upon an accrual definition of payroll, or how that's going to lay out. We're assuming it's going to be based on a cash basis of payroll. But again, obviously we don't know the answer to that until the final regulations are out. So you may get squeezed in a situation where, because it happens tomorrow, you may only be able to fit 3 payrolls in there.
We're assuming it's going to be on a cash basis for the payroll. That's typically how these would probably be looked at. If you look at other loan, like work opportunity tax credits and things like that, it's always based on the wages paid, the actual W-2 and 941 wages, not on your accrual. So I would very much think it's probably going to be a based on when you pay things.
Go ahead, Ed. I'm just reading other questions to see if I can find any that we haven't really covered yet.
Yep. That's what I'm trying to do the same thing. I'm trying to make sure that there was something that I asked earlier that make sure we kind of got the.
So here's one. If an employee earns $90,000, has medical insurance paid by the company in the amount of $15,000, does that make the salary $105,000 ineligible, or not, or no, because the salary is $90,000? So let's talk about this from 2 perspectives. The first one is the $100,000 threshold is only for the salary component of it, not the salary and other pieces. So the $90,000 would be the salary, and you would still get the $15,000 for the medical insurance. So the $105,000 would all qualify. The second piece here is understand that it's only the amount that exceeds that $100,000 that is excluded, not the full salary. So it's not that if somebody made 105, none of it's allowable, only the $5,000 would be non-allowable.
Okay.
Ed, your screen went black.
Yeah, I wasn't sure if we had a slide that said questions and thank you. That's the only reason why. Um, Let me see.
If employees were terminated for misconduct but will be replaced, is it still forgivable? The answer is it's going to go by FTE. It doesn't have to be the exact same employee. So it's going to be you're going to be looking at FTEs from the base period to the 8-week period after you obtain financing for the loan. So it doesn't have to be the exact same individuals. It's going to be based on an FTE perspective.
Someone said that they applied for a PPP loan on Sunday. The lender is asking for an EIDL promissory note. You would only have one of those if you had a pre-existing EIDL. You should just tell the lender that you don't have a pre-existing EIDL, and that should clear up that request.
What is the advantage here to small businesses? If no work and we are paying employees for not working, we pay all the employer taxes and workers' comp, et cetera, but we have no sales. How is this helping us? It's a good question. The way this loan was set up was set up to try to keep people employed, but there are some industries that this loan just doesn't seem to necessarily fit for, especially industries where the businesses are closed and there is no individuals who are currently working. So this may not be a full advantage for those types of businesses. Again, you're going to have to evaluate, look to see if this is really the best fit for you, or if there are other options out there that might be better for you.
Someone asked, will I pay 1% on the forgivable portion from day one or after the 8 weeks? So the interest starts on the loan from disbursement. The regulations that I have read has said that the interest on this is not going to be forgivable on the forgivable piece. So keep that in mind as well. But I wouldn't be surprised if that was a misinterpretation of some regulations that came along. But from what I've read, the interest starts as soon as you get to disbursement.
A lot of people are asking if they can accelerate expenses, if they can provide bonuses, if they can do any of these types of things. The truth is, we don't really know. I'm assuming that that is not going to be copacetic for you to be accelerating any type of expenses. I'm assuming that they're going to look at what your typical expenses are for that 8-week period of time. And if you try to quote unquote game the system and pull other expenses into there, that's not going to be appropriate. But things like bonuses and stuff that may or may not be allowable. So again, I think we have to wait for the forgiveness information to come out. But again, I wouldn't be counting on the fact that you can kind of front end load expenses like paying extra rent or making up for salaries you didn't pay people in the past or rent you didn't pay people in the past. I think it really is going to come down to the actual cost incurred for that period.
What about the timing of 100K? So it's 100K on an annualized basis. So if you have somebody that makes 105,000 per year annualized, they have the reduction in the 8-week covered period. It's not just once you go over 100 of actual incurred, you do it. It's based on what the rate of pay is on an annualized basis. So keep that in mind as well, that if you have someone that makes 120 throughout the year, but right now we're 4 months into the year, so they've only made 40,000, that they are still over 100,000 annualized, and they will have to have a reduction on both the PPP calculation and on your allowable uses.
Okay. Again, a lot of these questions, and again, I may be skipping people's questions, or we may be skipping people's questions, but a lot of them are fairly similar, and I think we've kind of touched on this in a lot of cases. Yeah, again, I think a lot of these are things that we've touched on. Hopefully, I think we've covered most of the items that are here.
I think so. I'm not seeing, I think we've covered it in one way or another.
Yeah, I mean, somebody said, how do we hand out money not knowing all forgivable costs? Makes no sense. We don't disagree with you. We're in a situation, I mean, if you go under the premise that the salaries for your staff up to $100,000 per employee, the health benefits for the employer portion, the state taxes that we talked about, unemployment and MTA tax, the pension contributions that you're making, rent, utilities. If you go under the basis of those expenses, you've probably got a good sense that those are most likely going to be allowable expenses and forgivable costs, providing that you're not getting funded for them directly through another source.
Someone's asking if this will be available audio and video. So I have it set to be recorded. Hope I didn't mess it up. I see the little record button working, so that should be fine. And then we will get on the website as soon as we can. It does take some time to render this video afterwards, though, as I learned from my last couple webinars. So we'll get it up as soon as we can.
One last question, I think. Someone asked, are temporary salary increases during the 8-week period forgivable? I think if you are paying certain staff members for things, as I mentioned earlier, like combat pay, because they're on the front lines or they're working directly with individuals who have the coronavirus, or they're putting in extra hours and stuff because of it, and you're paying them extra money for that, then by all means, I would think that would be an allowable cost. So the answer would be yes, if there is a additional cost being incurred because of work that's being performed.
Yeah, I would agree there, Ken. That's a pretty fair statement.
Okay. Again, I know there's still a lot of questions, and I know we didn't answer everybody's questions. I mean, we still have 38 questions that we didn't respond to. But we appreciate everybody's time. It is the seminar theoretically is over now. If people do have questions and they do want to follow through, please feel free to reach out to us. We're more than happy to help everybody through this. We understand that this is not the easiest thing in the world. It's very, very complex. We're all kind of building the plane as we go along, and it's not easy. So, we're here for you. Hopefully we can kind of help you through this. And hopefully, this presentation made things a touch clearer than before.
And make sure to ask Ken, not me. He's a lot nicer.
Thanks, everybody, and
Thank you.
stay safe. Stay safe.
Thank you. Bye.